Welcome back to Do More with Your Money. On today's episode, I am joined by Jeff Lesage, founding partner of Liquid Stock, a fully independent, institutionally backed investment firm that provides liquidity to employees and shareholders of late stage private companies. At Liquid Stock, their mission is to empower people and the companies they built with the freedom of liquidity to maximize the full potential of their equity. Jeff, thank you so much for coming on the podcast.
Thanks for having me. I appreciate.
Awesome. Well, I always like to start with just understanding a little bit of the why, basically how liquid stock got started, and maybe a little bit about your story and how you got to where you are today.
Yeah, so I was actually a lawyer by training. So I was a partner at Gibson Dunn in Los Angeles, and I practiced corporate and securities laws. And I had retired young and actually started a private equity firm when I saw what my partners were doing and helped one of the capital partners they were looking at with this structure and realized that they were onto something really special based upon my experience of working with companies and founders thinking about these issues in sort of the same way that everyone had always done it in the past.
Okay, excellent. Excellent. So, what are some reasons that so at liquid stock, basically what is the value proposition there?
Yeah, so two main use cases. One is option exercise. And so think of situations when any, whether it's a founder, C suite, any employee is sitting on options. Typically, they have the capital to pay the exercise price, but they don't have the capital often for the embedded tax obligation, which can get to be significant over time. And the second use case is funded shareholder. So it's a founder who already has founder shares, or it's an employee who was in tune enough to exercise their options before, but they don't want to sell all of their position. And that's where liquid stock comes in. We have a structure which allows for the employee or shareholder to use their shares as collateral for an advance, but doesn't it isn't a loan, and also doesn't require them to sell their entire position, which oftentimes isn't the right outcome and isn't tax efficient either.
Okay, so what would be some like common reasons from just like a general lifestyle standpoint that somebody may want to access equity, right, in their company that's not liquid, that's private company shares? What are some common reasons you see for people wanting to access their equity?
Yeah, so I think it's two things. One of which is think about just option exercise. So you're an employee and you're at your company. You're happy at the company. You want to stay at the company. Your IPO is coming, and the question you have to look at and decide is when do you exercise your options? And that actually is the same question that companies now are asking, where before it was really thought, okay, we want to lock everyone down to their desk and we're not going to allow them to exercise their options because that gives them mobility to be able to leave the company. Now companies are really focusing on, okay, how do we maximize the net worth for our people? How do we get them fully vested in the company and align them with our shareholders and the mission of the business? And it's the same question, both for the employee and for the company looking at that. And it really comes down to finding a point in time when the 409A value, which is the value that the company sets using a third party independent valuation firm, is low enough and below market enough where you have the ability to exercise those options, establish your basis, and convert from ordinary income to capital gains.
Hmm.
And one of the things you want to do is do that at least 12 months before your event so that that capital gains is now long-term capital gains. And there's a bunch of other tax levers that the employees can utilize in that time period when you're actually now a shareholder and not an option holder.
Mm. Okay, so there's benefits to having the direct ownership as opposed to the options, because if you haven't exercised your options yet, then you're not yet a shareholder.
Yeah, and what happens is you just net exercise upon the event, whether it's an IPO or M&A event, and that's not tax efficient. So you're carrying ordinary income all the way up to whatever the value of those options are, and that assumes also that you're there when that event happens. So one of the things that we provide is whether you call it an insurance policy or an ability to sleep at night, but if you were to pass away, if you had to leave the company for some reason, a life event, if you wanted to leave the company, you really get in a tough position as that 409A increases over time. You get to a spot where you can't pay the embedded tax obligation because
Hmm.
it keeps getting higher and higher, and ultimately, you know, providers like liquid stock won't be able to provide you enough capital based upon your collateral coverage to be able to pay that embedded tax obligation. That's why it's a real interesting exploration for both companies and employees. When's the right time to either exercise your option if you're the employee, or if you're the company, to look at your employees as a group and say, okay, we know that we want our IPO to occur in 2026. Okay, if that's the case, then we really should be thinking about an option exercise program in 2025. And that's very different than how companies used to think, which is just, okay, we want to tide them over, so we're going to have tender offers in 2024 and 2025. And the problem with, or allow secondary trades. The problem with those is that a lot of those folks are still sitting in options, and it's highly inefficient to sell into those tender offers or secondary share um, sales. And that's exactly the wrong time. You don't want your employees selling. You want them fully invested in the company. And that's the advantage of liquid stock. It's the first security I saw where it was a win for the founder employee, it was a win for the company, and it was a win for the investors. And it was something that I knew we could institutionalize as a new asset class.
So a lot to unpack there. And so basically, with options, people that own options should be considering exercising and considering the tax implications, because there can be things like alternative minimum tax, which is that part of the providing liquidity is to potentially pay taxes like that.
Absolutely. So now you're separating the type of option, which you're getting a little deeper between non qualified stock options and incentive stock options. But in either case, it's paying the embedded tax obligation associated with that option today at today's fair value, that
Yeah.
409A value, and then becoming a shareholder. And at that point, you've established your basis. Any gains beyond that are now capital and not ordinary. And that's huge on a number of levels as you run the math, because that 409A value, today's fair value, may be very different than the value upon your IPO or the point in time when you're actually going to sell those shares. The other thing it allows you to do is to potentially move out of a high tax state. So, what we see a lot happening is folks who are really tax planning into those events, and they're moving from California to Florida, or they're moving from California to Texas, or California to Nevada. And then I think we're going to also see a lot of folks moving to Puerto Rico as well, utilizing that same playbook where you're exercising your options, establishing your basis, and on that day moving, to one of those places to not only now are you getting all your gains as capital in nature, but you're also maybe not paying 13.3% in state tax
Right.
to California.
No, that makes a lot of sense. What would you say are some of the trade-offs about exercising earlier? Obviously, there are still risks involved, right? Depending on, that because the 409A valuation isn't necessarily always going to increase. So are there times where maybe it doesn't make sense?
Yeah, I think if you look at both use cases, one of which is the option exercise, the good thing about option exercise, if you can use your own capital, that you're always the best off. There's a portfolio construction question like if that's your only asset or it's 95% of your net worth, maybe you don't want to, and then you can find a provider like liquid stock. We'd say find liquid stock and not a provider like liquid stock, but um, that's your best alternative, assuming the value of the company is going up. Now, what you don't want to do is put money into a company where the value of the company is going down. Now you've paid taxes up to that amount, and your end result isn't going to be good. It's one of the advantages of using liquid stock is that in that situation, it's not your capital; it's our capital that's put to work. But that's one area to really understand on option exercise. It works great when the value of the company is going up. It doesn't
Right.
work as well if the value of the company is going down. And then the second use case is liquidity for own shares. And in that situation, you're really comparing a structured transaction like ours to selling. And so you would have been better off to sell those shares in that tender offer or in that secondary deal than our transaction if the value is going down. And so if you think that the company is fairly valued or overvalued, you shouldn't use your own capital, and you probably should sell. And that probably comes in. You have to run the math on what we look at it as probability of outcomes to see, okay, here's the math. You can look at where you think the likely outcomes are going to be, where you're better off either waiting to net exercise in the use case of option exercise, or alternatively selling versus using liquid stock. And that math will really tell you a lot. And folks who don't go through take the steps to actually see that math, that's where you can make a big mistake. And by big mistake, it it obviously isn't life shattering, but it can be significantly different outcome depending on that decision.
No, absolutely. Tell me about the actual liquid stock structure as far as so we're providing liquidity to access your private company equity, right? Whether it's restricted stock, stock options, what does that actually look like? How are you compensated? Just talk a little bit about that.
Yeah, so it's easiest, I think, to break it down to numbers. So let's take an example. You're a owner of Stripe or Databricks or Grammarly or Epic Games, and you're in a situation where you think, and the market thinks, and liquid stock thinks the company's going to go public in 1 to 3 years, and you have that 3 million of equity value, but you're an option holder, and you have 100,000 of exercise price that you need to pay to the company, but you have 900,000 of embedded tax obligations that you need to pay in order to exercise those
Tax
options today.
obligations from what? From which kind of tax?
So it could be it may be AMT, it
Mhm.
may be ordinary on non-qualified stock options, but there's a tax due if you exercise your options today. But if you exercise your options today, you lock in that basis at 3 million, and you actually think the value of the company is going to 6 million upon that IPO, either because that 409A value is below where the market's trading, which often happens, or because you have belief in what the company's
How
doing
do you know where
and
the
you.
market's trading relative to the 409A?
So one of the great things now is that there are a lot of different platforms which have come out that actually have active trading and active data about what's happening in the market for companies at that phase. And so there's companies like Zenbato, Hive, Forge Global. And so those marketplaces are, you know, if you're in the community, you're really following where those trades are and that information. And that may be very different than where the 409A value sits. At some companies, it gets closer, and our product doesn't work as well. Our product works really well when there's a big spread between the two. So going back to that example, you have 3 million of equity in value on paper, but to exercise you need a million. We'll give you the $1 million today. And one of the benefits of our structure is we give that to you on a tax exempt basis. So if you were selling shares to get back to the million, you may need to sell 1,800,000 worth of shares or 1,600,000 worth of shares, depending on your tax sort of situation, what state you're in, what your bracket is, et cetera, whether it's AMT or ordinary. And the um, the fact that we can then get you that $1 million, you can use that on a tax exempt basis. You're now shifting when you exercise from ordinary to cap gains. That's what we call the second lever. And then our security doesn't have any fixed maturity date. It's one of the advantages versus a loan. In a loan, you may have a term that's 5 years or 7 years, and you say, oh, well, certainly it's going to happen in 5 years. And anyone who's been around the last few years has seen it doesn't always happen. And so one of the reasons that our agreement is structured this way is because it often takes longer than people think. Sometimes it can happen quicker, but our settlement happens when there's an actual event. And upon that event, you then have to settle our agreement, not upon a specific date and time. And assuming that you end up paying us back more than $1 million, let's say you pay us back 1,500,000, and at that point in time after the IPO, that $500,000 is a tax loss that you can use to offset gains in your shares. And so
Okay.
we have those three different tax optimizations, and ultimately we're just creating value by optimizing those taxes, and we're sharing in that value creation.
So basically, the way you've structured it, as opposed to a loan, you can actually use that cost of accessing capital to be a loss to offset your future capital gain as well.
Exactly.
Okay, so that's pretty powerful there. And maybe you can't talk to the specifics, but I'd like to know, just so you mentioned, like, oh, we, for $1 million and maybe 1.5 million, how is that actually structured as far as like the repayment agreement?
So for us, it's simple. For others, it's a little more complicated, and that's because we're the investor, and there are a lot of brokers in the market that we're in, so they have to layer in like an origination fee or what they call a contract fee. But for us, it's simple. We have two basic costs of capital. One is time based, and think of that as just an accruing time return. That varies depending on what is happening in the market, but it typically now is in the 10 to 12% range. And the second one is an equity sharing. So we look at a percentage of those collateral shares, and we use those as a reference security to see what those are worth at that point in time when you have your liquidity event, whether it's an IPO or M&A event. And so those two forms of capital, the time and the value, arrive at whatever the number is. And we're taking equity risk as well. And
Right.
so in the event that the value, that 3 million of collateral, is now worth less than a million, our agreement is recourse only against the shares. And that's a big difference against a loan, obviously. So let's say that the value of those 3 million at the time that you have your event is only worth 500,000. You only need to pay us back 500,000. And in that situation, you actually have a capital gain in our agreement, but you would have a offsetting capital loss in your shares because you had basis at 3 million, and now you sold them at 500,000. So you'd actually have a $2.5 million loss in your shares. So it's interesting how those two costs, those losses and gains, really offset each other with our security, and that goes all the way
Sure.
down to zero. So if you go back to the dot com era, for those of us who are old enough, back then all we had were loans, and the secondary market was just starting. And there were some people who were able to access at that point in time non-recourse loans. Most required personal guarantees,
Mm.
and so the folks who had personal guarantees had to declare bankruptcy, and the folks who had non-recourse loans thought they were okay. And then what they didn't realize is there's something called elimination of indebtedness income, and so now they have a tax hit from the IRS. And I had a bunch of friends who they all had to declare personal bankruptcy because of that, even when they were in situations where it was non-recourse. And interestingly, by design, our agreement, because of the fact that it's capital and not elimination of indebtedness income, you get that situation where it goes to zero, and you
It's a
have a
loss.
gain in our agreement and a loss in your shares that offset each other. So it works in both directions.
So, if I'm understanding correctly, the benefit of your type of structure is that it's non-recourse, meaning that it's really you kind of sharing that equity risk, that capital risk, in the sense that if the valuation decreases, you're not on the hook for what you've borrowed. You're just percentage of the existing equity value. Is that
Yeah, and
correct?
again, it's not a loan, so they're not borrowing, but you're not having to pay back the full amount of the advance. So it's non-recourse or recourse only against the shares, the value of the shares. We take equity risk, as you're pointing out, and there's no fixed maturity date. And so the only way you can default under our agreement is if you're a bad actor. And that's, you don't pay us when you have the settlement event, or in situations like you move and you don't tell us about it. You actually can move anywhere, you just need to tell us about it. But if you move to an island somewhere and don't tell us about it, that would also be what we call a bad actor event. But those are the advantages of our structure. And then the disadvantages are really the cost of capital. And
Mm-hmm.
then really for folks looking at their own situations and seeing, do I have a better alternative? Can I use my capital? Is it better to wait till the IPO because the value isn't going to increase a lot from where we are today? Or alternatively, if you're comparing if it's liquidity and you're comparing the liquid stock structure versus a sale, is the value of the company going down? Those would be sort of the levers to think about what's the right alternative. And sometimes, by the way, it's a mix. Sometimes you want to sell some and use liquid stock for some. And
Sure.
and that's really the beauty, is you start to study it and study those probability of outcomes. You can really get to what you think is the best answer for you, which may hedge the risk of what those outcomes may be, both in terms of time and value.
Got you. In the, I know it's I don't want to get too in the weeds, but with the incentive stock options, and if somebody does have an AMT liability, right, you can provide liquidity to pay that tax. But
Correct.
let's say again, it is like unfortunately like a dot com situation, right, where you pay this AMT tax, the valuation decreases. Like you said, you're not getting that money back that you paid. But in that case, just run me through again as far as what they would be on the hook for. It's just the percentage of the equity remaining, or
That's
what?
exactly right, which is just the value of the collateral. And so the beauty of it is you're using our capital in that situation. It's the same for incentive stock options and non-qualified stock options. It's just that for incentive stock options, the amount of tax is less.
Mm-hmm.
And one of the big things, for if there's anyone listening here who has incentive stock options, to think about is those are the best options to work with. Those are the best options to exercise because that tax is lower. And what unfortunately has happened a lot before liquid stock came around is that people would inadvertently, is probably the wrong word, people would convert from incentive stock options to non-qualified stock options when they need more time. So when you leave the company, companies that have good culture and really think about their people, they allow for an extension of that time period for you to exercise. And one of the things that happens when you agree to that extension is that you automatically convert from incentive stock options to non qualified stock options. And that is a massive tax hit
Right.
that you don't need to take. And so, one of the things that everyone should do and companies should study for their employees is, hey, we'll give you this extension, but recognize the cost that comes with this, and there's alternatives that may be better for you that you should explore at that point in time. That's one of those points in time when people really should study it, is when you're potentially moving from incentive stock options to non-qualified stock options.
So if I'm understanding correctly, in a situation where maybe you're only have a limited amount of time to exercise your options because maybe whatever termination, etc., you want to consider in that situation getting the clock ticking on long-term capital gains using your type of solution versus converting to those non-qualified options where now you have no ability to get long-term capital gain. It's just going to be ordinary income with that
It,
decision.
yeah, and you may in the future, even if you converted, you may still have the ability to exercise those non-qualified stock options in the future. It's just the amount of tax that you're going to pay to do that increases. And so one of the things that happens is, you may get to a point where that fair value, that 49A value, has gotten too high, and you don't have enough collateral coverage. So if we come back to that example where you have 3 million of paper value in those options, maybe you only needed a million at the point in time when you had incentive stock options, but the moment you convert, you actually need 1,000,005,
Right.
not a million. And liquid stock will only give you a million. So now your choice is, oh shoot, I have to also put in 500,000. And at that point in time, you may be up against losing those options because you got an extension, but now the company still hasn't gone public. And so that's the risk part,
Yeah.
where times you look at it and you say, you know, I don't know where the value of the company is going to go, but I do know that I want to become a shareholder today. So I don't get in a position like that where the outcome is I can't exercise because I don't have that additional capital. And the amount that liquid stock or someone like liquid stock would give you is not enough because the 409A, that fair market value, is increased too much and made that tax burden
Too
too
exorbitant.
high.
So talk to me about what does that limit entail? Like how are you determining when it becomes too much because the valuation is increased?
So we look at that advance rate, and we typically advance in the around 30 to 35% range. And so in that example, on 3 million, we're giving you $1 million. It's 33% of the
I see.
value of those collateral shares. And that gives us that downside protection in the event that the value of the company goes down. And so, you know, there are situations where that advance rate can get as high as 50% in some companies where the risk is lower or perceived to be lower by the capital provider. And so if you're at a very, very late stage company where, maybe the company's already filed their S1, maybe they're on their roadshow, and the investor thinks, okay, we're pretty certain they're going to go public, you may see that advance rate go from 33% up to 50%. And in that situation, we cover the full 1,000,005. But that's how to think about those
I
points
see.
in time. And that's why it's really important to explore it a little bit earlier than you may even think is the right time, so that when you get to that point in time, and that's exploring it either as the company or the individual and option holder,
Hmm.
to say, okay, now is the right time to actually exercise.
And just to be clear, you only work with private companies, correct? There's no publicly traded stock.
That's right. And one of the reasons is when the company's public, you actually can get collateral coverage from banks for those shares because it's liquid.
Right. It's
And
market
so
market.
Goldman Sachs or Morgan Stanley, you can get a a loan that's on the value of those shares at that point in time, and so you wouldn't need a liquid stock. So we're we're in people confuse us also as venture investors, and we're really not taking venture risk, meaning we're not investing in companies where the outlook hasn't become pretty clear. You're not 1 to 3 years to your liquidity event, and we're also not investing when you're public. So we're sort of
Time frame.
in that time period where the company has gotten beyond being venture back. They're venture back, but the venture risk is gone. But you're not yet public.
That makes sense. And where does the capital come from? Like for that you're providing to, the individuals.
It's a great question, and it's actually the first question that if you're an individual, you should ask whoever you're talking to. We are the capital provider, so we're the investor. There are a lot of brokers in the market, both in the secondary market and in the structured secondary market. And so those brokers are the ones who are layering in additional fees into the transaction. And there are some even larger firms that look like capital providers from the outside, but they're actually getting those capital. They're sourcing that capital from other places. And there are also platforms that do the same. So there's a platform called Equity B, as an
Yes.
example, where they're they're just actually matching investors with the employee option holder, and they tend to do a lot of the market that the liquid stocks and our direct competitors don't actually. Maybe it's too early, or it's in a industry that we don't underwrite. That would be a great place to go to Equity B and see if you're able to get liquidity utilizing the same structure that we have, but accessing it through their platform.
I see. So just to be clear though, the actual like investors behind liquid stock, is this individuals, institutions?
Institutions.
Okay.
So think about big Wall Street firms. Like one of the things I said at the beginning, I thought we could institutionalize this. Before liquid stock, there were firms that were using our structure, but there were either smaller funds that were friends and family funds, or they were going off and doing them on one-off transactions, finding capital partners for those deals, sort of like Equity B does, but not on a platform basis. And what I knew looking at it from the risk return profile is that for companies at that stage, they're actually very good credit risks. And we knew that we could get institutional backing from Wall Street. And so we're in a traditional fund structure with Wall Street backers, some of the same backers who the companies will use for their investment bankers, lead left, lead right in their IPO. And so that's where you have sort of synergies with liquid stock. Is we are the institutional provider in the space, and with that you get the benefit of working with the capital provider as opposed to working with brokers who are sort of stitching together
Layering.
that for your transaction. And that in those situations, you're going to have contract fee, origination fee, broker fee, whatever they're going to call it, that can range up to 6% of the transaction. So that can be a significant additional cost that you're paying to the broker in addition to paying the capital provider the two costs of capital that that liquid stock would charge you.
Which you said typically it could be 10 to 12% plus the percentage of equity.
Correct.
Okay, awesome. And is there a minimum amount of equity typically that people would need to work with liquid stock?
Yeah, that's a good question. It really varies depending on whether it's a company we've already underwritten. We like to work with companies, and so when we've already underwritten them, we'll do smaller transactions. That small size of transaction gets down to about 250,000. So you need in that situation, going back to that 33% advance rate to think about, you need about 750,000 to $1 million worth of equity in that company to sort of be in the size where liquid stock would make sense for you. If you're below that, I would recommend going to like an equity B as an example. And if we haven't underwritten your company, then that amount gets higher because we have to take the work of, okay, now we're going to really have to dig in and understand the value of the company, the risks in the company. And in those situations, oftentimes we'll also need to get access to the company itself. And so those situations are a little bit harder because they just take more work and time. And
I
so
see.
that the value will, the sort of size of those first transactions would have to be a little larger.
Okay, that makes sense. Yeah, so basically, you guys are obviously doing your due diligence on these companies, and you're going to be more comfortable working with a company that you've already worked with previously.
Correct.
Awesome. Well, this is all very helpful. I mean, what would you say? So, for liquid stock in general, what is kind of the long term vision there? I mean, as far as where you're trying to build a company to.
Yeah, we like I said, this is we're still educating the market. We're still educating companies on how to think about doing something different. For 20 years, the playbook has been the same. And that playbook has forced people into bad situations where they lose their options. They're selling when they shouldn't. They're selling at valuations they don't like, and they're tax inefficient. And the way we look at our playbook is do great by the people we're working with, and they're going to tell more people. Almost all of our transactions actually are referred to us by folks we already worked with, either in that company or other companies. And companies now are talking to each other about this as a solution, that is either holistic for a group of the employees or all of the employees. And so we think that the market in this time is perfect, in part because the 49As have come down, but we view it as a longer term opportunity to really keep doing what we're doing in a way which changes the playbook of how companies have done things so that they really focus on their employees and they get the employee to the optimized position. That's both in terms of risk and their total value at the end of the day when they have that liquidity event.
Awesome. Awesome. Well, thank you so much. This has been very informative and you've provided a ton of value. But I always ask one question is to leave the audience with if there's one way they can do more with their money. It could be on the building wealth side of the equation, spending side of the equation. Maybe it's with their equity compensation. One thing you would leave the audience with.
Uh, I thought about that, and I love the question. I love it in your show. For us, what we love is that wealth creation. Like when we get to that point with folks we've worked with, and they've created so much more value, and they do something really fun with it. So we have a chalet. I won't name which city it's in, but it's in one of the ritzy ski cities that's named Liquid. We don't have a boat named Liquid yet. We have a lot of boats that yachts that people have bought, but I'd love to see a liquid stock yacht. And so that's my short term goal in life is to have someone name a yacht after us.
I love that. Okay, so if somebody experiences a windfall with their equity and use liquid stock as a solution to access that and be more efficient, maybe buy a boat and we can name it liquidity.
Yeah.
I love
Liquid
it.
stock,
Sorry,
liquidity.
sorry, my bad. Liquid
Or
stock.
it's liquid. Maybe it's just liquid.
Liquid,
I'd
yeah,
be
I'll keep
happy.
it short, Yeah, sweet. Well, awesome.
Well,
Where is the
well,
best place that people can connect with you and learn more?
I think the best spot is just through our website. I think following us, if you follow us on LinkedIn, what we try to do is just provide an education platform. Our whole business is built around education. So you can go to the website. We have a calculator on the website. If you think you're a good fit, um, you can contact us and we can start exploring either of those use cases: liquidity for own shares or option exercise. And if you're a company, definitely just reach out directly. We love working with companies, probably the most, because we can have the biggest impact across the company and help as many people within that company as possible. And I think, the takeaway for companies is times have changed. You need to think about the employees. You need to attract employees. We're a great tool for being able to bring employees over who can't leave because of their option situation in their other companies. And we're a great retention tool. And what we found over time is the idea that giving people the ability to exercise and make them owners in the company is just going to lead to exodus of people. That actually isn't the case. Our experiences is what happens is you now actually have people who are more vested in the company, and the outcome of the company. So look us up on either liquidstock.com or follow us on LinkedIn.
Excellent. Yeah, I love that, and I will link to both those resources in the show notes. But I love that idea of working with companies to help them better educate their employees and better retain employees, and help them maximize their equity so that they can have skin in the game.
So skin in the game is important.
Definitely is.
Being a partner in the firm as opposed to selling the firm is critical. Thanks for having me on. I really
Yeah, it's been a
appreciate it.
pleasure. Thank you so much, Jeff. Looking forward to connecting in the future.
Have a great one.
Take care.